In my book, Rich Dad, Poor Dad, I shared the lessons I learned about money from my own father and my friend's father, my rich dad. These lessons were not just about making money, but about understanding the very nature of money itself. My rich dad taught me that financial education is the key to navigating the complex world of economics and finance. One of the most important lessons was to understand how money works, and to prepare for economic storms. He emphasized that financial literacy is not just about knowing how to balance a checkbook or manage a budget, but about understanding the broader economic forces at play. This includes knowing how to read financial statements, understanding market trends, and being aware of the global economic landscape. Today, those storms are on the horizon. For years, I've been warning about the dangers of inflation, debt, and a potential financial collapse. These warnings are not based on fear-mongering, but on careful analysis of economic indicators and historical patterns. The signs are clear for those who know where to look. These warnings weren't meant to scare anyone, but to prepare them. Preparation is the key to weathering any storm, financial or otherwise. By being informed and proactive, you can protect yourself and your loved ones from the worst effects of economic downturns. This means having a diversified portfolio, keeping an emergency fund, and staying informed about economic trends. My predictions weren't based on guesswork, but on understanding how economic cycles work. Economies, like nature, have cycles of growth and contraction. By studying these cycles, we can anticipate changes and make informed decisions. This is not about predicting the future with certainty, but about being prepared for different scenarios. Just like the changing seasons, economies go through periods of growth and contraction. These cycles are natural and inevitable. However, the severity and duration of these cycles can be influenced by government policies, market behavior, and global events. Understanding these factors can help you navigate through economic ups and downs. What we're seeing now is the result of years of irresponsible financial policies. Governments and central banks have been making decisions that prioritize short-term gains over long-term stability. This has led to a buildup of debt and financial imbalances that are now coming to a head. Governments around the world have been printing money at an alarming rate, creating a debt bubble of epic proportions. This excessive money printing devalues currency and leads to inflation. When too much money chases too few goods, prices rise, and the purchasing power of money decreases. This can't go on forever. The signs are everywhere. From rising inflation to increasing debt levels, the warning signals are flashing red. It's not a matter of if, but when the next financial crisis will hit. Being aware of these signs can help you take preemptive actions to safeguard your financial future. Inflation is eating away at our savings, making it harder to afford basic necessities. The cost of living is rising, and wages are not keeping pace. This erodes the purchasing power of money, making it more difficult for people to maintain their standard of living. Housing prices are skyrocketing, putting homeownership out of reach for many. The dream of owning a home is becoming increasingly unattainable for the average person. This is not just a financial issue, but a social one, as it affects the stability and well-being of families and communities. And the stock market, fueled by cheap money, seems increasingly detached from reality. Stock prices are soaring, but this growth is not based on solid economic fundamentals. Instead, it's driven by speculation and the influx of easy money. This creates a bubble that is bound to burst, leading to significant financial losses for investors. We are at a tipping point. The question is, are you prepared? Preparation involves more than just financial planning. It requires a mindset of resilience and adaptability. By staying informed, diversifying your investments, and being proactive, you can navigate through these turbulent times and emerge stronger on the other side. Inflation is often called the silent thief because it steals the value of your money without you even realizing it. It's a gradual process, almost invisible, but its impact is profound. Remember when a gallon of gas used to cost just a few dollars? Those were the days when filling up your tank didn't break the bank, or when you could buy a loaf of bread for less than $1. It seems almost unbelievable now, but that was the reality not too long ago. Those days seem like a distant memory. That's inflation at work. It's a slow erosion of purchasing power, making everything more expensive over time. Today, inflation is at a 40-year high. This isn't just a statistic, it's a reality that affects us all. Prices for everything from groceries to gasoline to housing are soaring. The cost of living is climbing at an unprecedented rate. This isn't just an inconvenience, it's a real crisis for families struggling to make ends meet. The rising prices are squeezing household budgets tighter and tighter. It's a real crisis for families struggling to make ends meet. Many are forced to make tough choices, cutting back on essentials just to get by. Wages aren't keeping up with the rising cost of living, creating a gap that's hard to bridge. Even with a paycheck in hand, many find it doesn't stretch as far as it used to, leaving many people worse off than they were a year ago. The financial strain is palpable and the stress is mounting, and it's only going to get worse. Experts predict that inflation will continue to rise, making it even harder for families to keep up. The silent thief is relentless, and its impact is far-reaching. Another major problem is the mountain of debt that we've accumulated, both as individuals and as a nation. Credit card debt, student loan debt, auto loan debt, it all adds up. Many people are living paycheck to paycheck, just barely able to make their monthly payments. This is no way to live. But it's not just personal debt that's a problem. The national debt has ballooned to an unsustainable level. The government keeps spending more money than it takes in, and it's borrowing to make up the difference. This can't go on forever. At some point, creditors will lose faith in the government's ability to repay its debts, and the whole system could collapse. The global financial system is like a house of cards. It's built on a foundation of debt and speculation. For years, central banks have kept interest rates artificially low, encouraging people to borrow and spend more. This has created a bubble in asset prices, from stocks and bonds to real estate. But what happens when interest rates rise? The cost of borrowing goes up, making it more expensive to service debt. Asset bubbles start to burst, and the whole house of cards could come crashing down. We've seen this happen before, most recently in 2008. But this time, the consequences could be even worse. Section 5. Echoes of 2008. The 2008 financial crisis was a wake-up call. It exposed the fragility of the global financial system and the dangers of reckless lending and borrowing. But have we learned our lesson? Not really. In many ways, the situation today is even more precarious than it was in 2008. Debt levels are higher, asset bubbles are bigger, and central banks have even fewer tools at their disposal to deal with the next crisis. We're living on borrowed time. The next financial crisis could be just around the corner, and it could be even more severe than the last one. Section 6. The dollar's demise. For decades, the US dollar has been the world's reserve currency. This status has given the United States significant economic advantages, allowing it to borrow money at lower costs and run larger trade deficits with minimal immediate consequences. This means that other countries hold US dollars as a store of value and use them to conduct international trade. The dollar's dominance has facilitated global trade and investment, creating a relatively stable international financial system. But the dollar's dominance is under threat. Recent economic policies and geopolitical tensions have raised questions about the long-term stability of the US dollar. Other countries are starting to lose faith in the US dollar as they see the US government printing more and more money. This excessive money printing can lead to inflation, reducing the purchasing power of the dollar. This loss of confidence in the US dollar could have severe consequences. A weaker dollar would mean that the cost of imports would rise, leading to higher prices for goods and services in the US. It could lead to a decline in the dollar's value, making imports more expensive and fueling inflation. This inflationary pressure could erode the savings of ordinary Americans and reduce their purchasing power. It could also make it more difficult for the US government to borrow money, leading to higher interest rates and slower economic growth. Higher interest rates would increase the cost of borrowing for businesses and consumers, potentially leading to reduced investment and spending, and ultimately, a slowdown in economic activity. As other countries explore alternatives to the US dollar, such as the euro or the Chinese yuan, the global financial landscape could shift dramatically. This shift could reduce the influence of the US in global economic affairs and alter the balance of power in international finance. The potential demise of the dollar as the world's reserve currency is a complex issue with far-reaching implications. It is a situation that requires careful consideration and strategic planning to navigate the challenges ahead. The future of the US dollar will depend on a range of factors, including economic policies, geopolitical developments, and the actions of other countries. It is a critical moment for the US to address these challenges and work towards maintaining the stability and strength of its currency. Section 7. Preparing for the storm. The good news is that it's not too late to prepare. The first step is to educate yourself about what's happening in the economy and why. Don't rely on the mainstream media or politicians to tell you what's going on. Do your own research and come to your own conclusions. Once you understand the risks, you can start to take steps to protect yourself. This might include paying down debt, investing in assets that hedge against inflation, or diversifying your income streams. The key is to be proactive and not wait until it's too late. Section 8. Taking control of your finances. The most important thing is to take control of your finances. Don't rely on the government or anyone else to bail you out. Take responsibility for your own financial well-being. Live below your means, save money, and invest wisely. Remember, the goal is not to get rich quick. It's to build long-term wealth and financial security. This takes time, discipline, and a willingness to learn. But it's the surest path to financial freedom. Section 9. A time for bold action. We are living in challenging times. The old rules of money no longer apply. The financial system is rigged against the middle class and the poor. But this is not a time to despair. It's a time for bold action. Educate yourself, take control of your finances, and prepare for the future. The storm is coming. But those who are prepared will be the ones who not only survive but thrive.